It is an indicator that fully replaces a traditional candlestick chart to a Heikin Ashi chart. When applied, it tends to give less noise than a traditional candlestick. A green Heikin Ashi candle signals that the price is on an uptrend, and a red Heikin Ashi candle signals that the price is on a downtrend. The size of the candle's body also indicates how strong a trend is. The larger the candle, the stronger the trend. Keep in mind that the Heikin Ashi only acts as an indicator. It does not display the real market price. Moon phases. It is a concept that utilizes moon cycles to time the market. Moon phase traders believe that moon cycles are correlated with human emotions and behavior, which could have an influence on the market. Specific moon phases are believed to be favorable towards a certain trend. A new moon means the market tends to be bullish, and a full moon means the market tends to be bearish. Today, it is used mostly as a confirmation tool. Renko. It replaces a traditional candlestick chart to a Renko chart. So, unlike a traditional candlestick which forms a new candle based on a certain period of time, a Renko chart forms its block based on the change of price. For example, every 1% change in price, a Renko block appears. This means that each Renko block represents a 1% change in price. Of course, you can change the parameters of this through the indicator settings. Traders could utilize Renko charts to filter out noise and identify trends. A green Renko block signals an uptrend, and a red Renko block signals a downtrend. And keep in mind that Renko charts only acts as an indicator. It does not display the real market price. Harmonic patterns. These are advanced price patterns that follows a specific shape based on Fibonacci numbers. Traders can then use these specific shapes to predict future price movements. For example, a bullish bat pattern is formed when price makes a series of 4 movements that is shaped like the letter M. Each point can be labeled as X, A, B, C, and D, and each of these points has a specific guideline. For example, point X to point B needs to have a value between 0.382 and 0.5. Point A to C needs to have a value between 0.382 and 0.886, and the same thing works for the other points. Next, these specific guidelines can then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline. If it does, then you can take a position based on the pattern that formed. There are multiple harmonic patterns that exist. Most notable are butterfly, bat, crab, and each have their own unique values. Support and resistance. These are key levels that formed horizontally where the price has bounced off in the past and could possibly bounce again in the future. If the level is below the price, it's called support, where you can take a buy position if the price approaches it, and if the level is above the price, it's called resistance, where you can take a sell position if the price approaches it. Dynamic support and resistance. Similar to support and resistance, dynamic support and resistance also acts as key levels. But instead of using static horizontal lines, it uses indicators like the moving average to act as our key level.